Okay, last time we met, we were talking about the next shoe to drop in the stock market, and that is earnings. The next big thing, we're going to be getting earnings warnings and possible earnings reports eventually that say the economy's not doing so good, and there's going to be earnings misses. So as soon as that starts happening, and a lot of companies jump in and say we're going to have bad earnings too, that could lead to like a big rush for people getting out of the stock market. So we had a note from FedEx that they're having problems. The CEO said that there's a good possibility of an economic recession around the world, and that's a company that has its hands in a lot of things for the economy. And if he's to say that, well, that is a very good indication that the economy is slowing. So let's see what's happening. Right now, we're down 1.38% in the S&P, and we're down since last week. We are in, let me see, get my meeting notes. Okay, we're in the worst month of the year. We knew in January that September is a bad month, so we have another couple weeks, 2 more weeks before September is over. Then we have November. Towards the end of November, beginning and the whole all of December is usually really good because it's holiday time with Thanksgiving and Christmas. So right now we're just in a position where we have earnings starting to come down, estimates, and a lot of companies are not giving guidance anymore. So it leads to uncertainty, and when there's uncertainty, the stock market doesn't like uncertainty. So the two big things with the stock market right now is the uncertainty of what the Fed is going to do with raising interest rates, and the uncertainty of earnings reports, and if companies are not going to meet their estimates. So because this month is traditionally a bad month, I just put let's put yellow here for the rest of the month. We have no idea. Whenever we keep track of our stochastics, and right now almost everything we're watching is in a downtrend. You see these near-term charts. Almost every one of these stocks we're following is in a downtrend, and we're in a bad month. So it's a very good indication that we're going to be continuing this pattern of lower highs, lower lows. The ones that are doing good, this utility sector is doing good. And energy seems to be in an uptrend also. But if we look at our S&P, let's look at our S&P in our chart. We're actually at a bottom right now of our downward channel. So it looks like if we're following this pattern, the next spot in this is up here. If we and the other thing, whenever we're looking at the S&P and we have a downward trending market, like we're selling off, look at past levels of support, and let's look at the S&P going back 1 year. Okay, look at these levels of support right here. These were in July, and this is in June. So you can see we're almost at a point where we're hitting the support levels from that way back in July, in June. This level of support we didn't hold. We have a support level there and here. That didn't hold. So this looks like 377 is the next level for support for the S&P. So there are some pretty smart people that are saying we're starting a sideways market, maybe for the next 10 years. And what that means is, let's look at the maximum for the S&P. The year 2000 to 2010 was basically a lost 10 years. All we did was we went sideways. And there's some smart people that are saying that we're going to go sideways for the next 10 years. And so we might want to adapt our strategy for investing because of that. Maybe increase our dividend portion of our portfolio and or trade around positions, which is assuming that it's going to be going sideways. You might want to trade around positions. So, all right, so that's the big picture. Let's look at what things we have to look forward to next week. Next week we have the Fed meeting on the 20th. That, if they have some kind of indication that we have maybe we're at a neutral rate, which means they're not raising anymore, and this is a good rate, that'll be really good for the stock market. It looks like in the 13th of this week, that was early in Tuesday or Wednesday, I forget, but we had a really bad inflation report, and that led some to believe that we're not going to be done raising rates on the 20th. So that affects the stock market in general, because the more they raise the rates, the worse it is for the stocks. And we do have an end of quarter window dressing, and if stocks are going down, no one pays attention to that. So in the stochastics, when we have these stochastics, when there's a free fall like there was in 2008, it doesn't matter. Everything's oversold, and it keeps going down. So this doesn't really mean anything anymore. This usually works really good in an uptrending market. We can see the buys. Like all last year, we were like, well, we know it was when it was going to go down and up, but now it's not as useful. So we have a consumer staples. This is basically at the bottom end of its range. We have a lot of people buying consumer staples today because it pays a dividend, and it's going to be in consistent demand in this environment, and it's conservative. So this is an example of a good group of stocks that will do good in this environment, and it's kind of down. And let's see. Go back to my meeting notes here. Right. So we always like to look for the catalyst to go up and to go down. 10-year yield continues to go higher. That's not so good, because we know it's up 6% this week, not including today. So last week it was our role is rates going up is good for banks, bad for stock market and growth stocks. And right now there's a really smart guy. He made something up here. Let me get this. Here's his comments. Goodbye, Tina. There is no alternative. Last year we were seeing Tina. The stock market was going up. It yielded 1.5%, and you really couldn't beat that anywhere around the world. And he's saying right now, hello, TATA. And there is an alternative, and that is 4% yields in the U.S. Treasury, which is guaranteed. So we're switching right now from TINA, and people are starting to see bonds and Treasuries, very conservative investments, as an alternative. So that means people are taking money out of the stock market and putting it into something more conservative. And that's kind of the trend that's happening right now. So this little note that Doug Cass said, he said the conclusion we can make from this is multiples of stocks will come down as interest rates go up, because people are not willing to pile into stocks if there's an alternative. And so we have to focus on stocks with that are close to their fair value, and their earnings are consistent, and they have a low PEG ratio. So the stocks with higher peg ratios. Could you hold on for a second? 1 second. Sorry about that. Okay, so the stocks we'll look at the stocks that are doing good and bad today. But my guess is stocks doing good today are the ones that are more conservative. Let's get this out of the way. Okay, so let's look at the percent gainers.
So, a note on that, Greg.
Yes.
If you're buying treasuries at which there for what, you're assuming that inflation is going to be coming back down to meet that, right?
Yeah.
And I understand that the equities, multiples will compress, but there's also danger, and you get the inflation danger of holding the equity, the bonds and treasuries.
Right. Yeah. So if inflation is 10% a year and it stays that level, and you're holding a 4% treasury, you're losing 6% in buying power every year. Is that what you're saying?
Yeah.
Okay.
And it's like that. Some people are buying. The tips yield like 0 or whatever plus inflation. So yeah, the inflation is a thing here that's affecting you. The rates are going up on the treasuries, but I think the inflation is also a big part of that story. Is that they're going up to work on the inflation, but that also means that you have to think about your real purchasing power over time of your investment too.
Right. So let me see. Right. So I think there's some bond people that say that this is one of the best bond times for bonds in a long time. I don't know anything about the fixed income market. I think Jake might know more about that than anyone because he knows, he specializes in that. You have to consider, even if you wanted something super secure right now, the 4% U.S. Treasury. Yeah, you're going to lose purchasing power if everything stays the same. But I think everyone in this group is convinced that the inflation is going down, and the Fed will do what it has to do to get it down to 2%. So over time, in the past 10 years, inflation has been 2 or 3% in the United States. So that's been very reasonable. So if you're buying a 4% yielding treasury, so over time, if it's 2%, you'll have a 2% inflation rate, then you'll net 2%. But if you just think, if you were in the 80s and you had 14%, you had inflation that was 20%, and then you had a 14% interest rate. If you ended up buying treasuries then, you would have a 6% loss temporarily, but we went back down to 2% over time of inflation. So that 14% yielding treasury back then was pretty good. So, all right, yeah. So that's a good little topic to bring up. So let's look at the market movers for today. Looks like all the home builders are doing good. They were tanking for a while because of there was a report about the inflation being bad. So if the inflation's bad, that came out on Tuesday. I think PPI came out. If the inflation's bad, that means the Fed will have to raise rates higher, and that'll make it harder for home builders to sell houses with higher mortgage rates. And so right now they're just bouncing back. They went down a ton earlier this week, so they're bouncing back. Every one of these is half of the top 10 are home builders, and Dollar Tree and Dollar General. There were people that were saying, I don't know, I forget who it was, but during the last 2008 time of turmoil, people gravitated towards Walmart because in stocks like that, because people trade down when they have less purchasing power, and there's inflation, and they don't earn as much as they used to, spending wise. So that's why Dollar Tree and Dollar General are doing good today. So let's watch Dollar Tree, Dollar General. Let's watch Walmart as three stocks that will do good as inflation remains high. FedEx is down 22%. Let's look at that article. Let me see. FedEx issues ominous warning about the global economy. They're down 23%. And the FedEx CEO said that he expects the economy to enter worldwide recession. So you can see that in the top 10 negative, half of these have to do with FedEx. Whenever one stock goes down, all other stocks in that sector go down with it, regardless of what the other companies are saying. So international paper, there was bad news about there's a glut of inventory, but all these have to do WestRock. Seems like a lot of them have to do with that FedEx. So JB Hunt, they're delivering through trucks, and you have UPS is down too, not as much. But you see the ones that are. Let's look at the NASDAQ. What's going up and down? Drug stocks. We have some drug stocks that are doing good, and we have stocks. Comcast, they announced that they're buying back shares. So we talked about 2 weeks ago or 3 weeks ago, we were saying that there's a new law that was passed, 1% surcharge are going to be placed on buybacks January 1st. So there's going to be a lot of companies like Comcast and J&J that said this week that they're going to increase buybacks. Let me see what else is going on. Just drug stocks and top decliners. Okay, we mentioned
your favorite is there at the top. DocuSign is the.
Oh man, we got to look at this. Yeah, this is my favorite worst stock. Okay, so if we go back to our meeting notes, things that are going to do good and bad. The ones with let me see. Companies with the lowest PE will be doing good. The ones with the highest PE are going to get crushed. And right now, DocuSign, let's look at that. See if it's even growing anymore. We were looking at this last year at this time, as an example of a stock that's super overvalued, that wasn't growing that much. Wonder why it went back there. Let's try it again. Yahoo Finance. DocuSign. Okay. So DocuSign, they do electronic signing of contracts. They did real good during the pandemic, and let's look at their growth and their statistics. We'll look at E-Trade. Okay, so right now they're still 2.25% overvalued. Everything's negative. These kind of stocks will get really hurt if you have a stock without a lot of these numbers filled in, and you have a high PEG ratio. Those stocks will go down to double the other stocks that are higher quality, that have a lower PEG ratio. So DocuSign, let's look at what it's growing at now. Because last time we looked, it was growing like at 13%, and it was selling for 113 PE. Let's look at DocuSign. DOCU. Earnings. Okay. So let's get our calculator out here. Okay, so from 165 divided by 183. So the visibility is only out 2022. So they're losing money from this year to next year. and then they're gaining 10% the year after that. 1.98 divided by 1.65. So they're losing 20% this year, and they're gaining 10% next year. So that's an example of an inconsistent. You can see it's not like a straight line up like we like to see. This was great, during the pandemic, and then people are back in their offices. So that's an example of a stock that's inconsistent earnings combined with they have no growth for the next year. It's still overvalued. It'll probably go down to 25 next or 20. Let's look at, these are all the Zscaler, these are Datadog, Airbnb. Every one of these is super high PE ratio stock. Let's look at, we looked at Zscaler last week. Let's look at Datadog, because we use that here in our development, so that it'd be interesting to see that. DDOG, is it DDOG? DDOG. Okay. I'm assuming this has a really high PE ratio. Statistics. Forward PE, 92. Okay, so its PEG ratio is 1.5. So according to Yahoo, it's growing at 45%. So let's look at Datadog, DDOG. Okay, Datadog is a company that provides software for cloud services. So it's going up in a straight line. We like to see this. This annual earnings looks like it's growing. They're growing their earnings like 0.78, about 1.10, 30%, 37%, 45%, 48%. Okay, so it's growing like 38%, let's say. You combine all that. So if it's a 38 growth and its forward PE is 92, let's do that. 92 divided by 48, it's 2 times overvalued. Okay, so those are the stocks that will get hit in this environment, because if it's only grown at 38%, the PE should only be 38. And in this environment, they don't have as reliable customers. We have, like Microsoft has, a broad base of products, broad base of customers, and this is an example of a stock that doesn't, in a bad time, I guess you wouldn't necessarily need Datadog services versus you would need Microsoft Office to run your company. So this is like example of a stock that could go down in half, and that'll be fairly valued. So I think the profit margin isn't very good. The return on assets. Okay, so this is an example of a stock with not a lot of good numbers. That the only good thing about the company is it's growing its earnings at 40% a year. A lot of these things have to catch up, as the company grows. But that's an example of a stock that'll get hurt. And so and right now the things that are working are the low PEG ratio stocks and the stocks that have consistent demand in any environment. And I think that's why people are gravitating towards the drugs today. We're looking at the top 10 market movers. Because drugs, you take them regardless. Gilead is a drug stock. You take your drugs whether it's high price or not. And okay, these are like cloud stocks and cybersecurity stocks. Okay, and the Dow. Let's look at the Dow. Johnson & Johnson, they announced a buyback, and they're a drug stock. They pay a dividend. These are all conservative dividend-paying stocks. Verizon, and the ones going down the most. This must be a news item on Boeing. I didn't see that. Okay, so if there's a worldwide recession, the price of oil is going to go down because the demand for oil the demand side, not the supply. The demand side goes down. So that's why I would think oil would go down more than it is. It's only, let's see, oil is only down. It's flat for the day on that FedEx news. But the one thing about that FedEx report, so let's look at this news from FedEx. They issue an ominous warning about the global economy. They're not delivering as many packages, and they don't see the demand. But let me see. Amazon is actually starting to deliver their own packages, and they're delivering other people's packages. So it could be that it's a company specific issue. It could be that they're seeing less demand because Amazon's taking a portion of their share. We don't know, but so that's how you can read into a story, and it might not be everything that it seems. So it's down 23%. Here's another guy on Twitter that's saying there's the shift in spending to services, and Amazon is handling more deliveries in-house. So there's a less, Amazon might be actually taking business away from some of the bigger carriers as they do it themselves. And Amazon's creating its own delivery service to compete with UPS and FedEx. But he did note that Visa and MasterCard have a pulse on the consumer, and they said there's an upbeat at what they're spending. So that's a contrary indicator that the economy's not that bad and consumers are still spending. So let's go back to some of our talking points. We have the catalysts for markets to go up and the ones to go down. The 10-year yield is still going up, and it's up 6% since last week. The more it goes up, the more the Fed has to raise their interest rates. So we have to keep that formula in mind and watch the 10-year. We had some really good news with ending the war in Russia. Russia is starting to retreat. There was a meeting between Russia and China and Russia and India in the past 2 days. China and India are pressuring Russia to stop the war, it seems. So that's good. So we have some check marks for the stock market to go up. Corporate buybacks, we had J&J, Comcast announcing buybacks. We avoided a train strike. That would have been really bad for the economy if there was a strike. So let me see. There was a bad report on inflation. It increased more than expected, and it's not really going down in the near term. So that is bad for the stock market. And that's about it. So it's good to keep an eye on that because almost every stock follows the S&P. And we're just trying to predict what's going to happen next in the S&P so you can dollar cost into whatever you're interested in. Right. Is there any questions on any of that? Right. So oil is pretty much unchanged since last week. I'm surprised. I thought it would go down. But the Treasury is up 6%. And that's probably one of the main reasons why the stock market is going down. You see, and inflation, it's still persistent. And so we don't see it going down 1% a month or like we really want it to. So next week at this time, we'll have a new statement from the Fed. Hopefully that'll help the stock market. Let's look at the sector ETFs, see what's going up and down. I think the home builders are going up. We know that. You see. Home construction, gold miners, and consumer staples. These are all utilities. These are all conservative. So people are I guess, gearing to a environment where yield is going to be important. So if we have another 10-year period of time, this is what Ray Dalio said. I think Jake was mentioning Ray Dalio is a really smart guy. He says we're going to be in an era for the next 10 years of sideways markets. If that happens, these are the stocks that are going to be doing the best with the high yield. There's a consistent demand, utilities, consistent high yield, healthcare. I guess we stop right there for the conservative sectors. The ones that are doing the worst, oil. Oil is probably doing worse because if there is a global recession, like the FedEx guy says, the price of oil is going down 20, 30, 40% maybe because there won't be a demand for oil. I'm surprised the oil price hasn't gone down, the spot price of oil, but energy, the energy stocks go down with it. So that's what's happening in the ETF sectors today. Any questions about that? Right. Okay, let's look at the chart on the S&P. Last week, we were at the top of the channel of this downward trending. We're in this downward trending channel right now. And now we're basically at the bottom part of that channel. So let's zoom in on that a little bit. Okay, so we were at the top of the channel going down. Now we're at the bottom part. And probably at the end of today, we're going to be at the bottom of the channel. And we do have support right here. If we hit the bottom of this channel, we have support back there. And then we have the June 17th support. That's like the bottom from the summer. For me, I'm using this to basically time. If I have some extra money to invest, I would buy like very small positions in the stocks for my long-term portfolio. I would buy a little here, buy a little here, and if we end up going into a huge crash, I would still buy a little bit at a time. But let me see. Let's look at the Treasury. We already talked about this. It's up 6%. It's 3.47 right now, and it's becoming, as an alternative to buying stocks. So that's not good for the stock market. So we want this to stay down, but it's stubbornly going up. And let's look at the Fear Greed Index. It is now, we're in fear. We were like neutral kind of last week. Now we're going towards fear. So as we get into this extreme fear, that is the time when people are selling, and that's the time to be actually looking at things for opportunities. And we always track the VIX too. The VIX is up to 27. And let's look at the VIX just because. So as the VIX goes up, that people get a little bit more scared. They're buying protection. It's contrary. It does the opposite of what the stock market does, basically. Oh, it's up 5% today. Wow. All right. So as we get up towards 34, we peak around 30 to 34, and that's when the stock market goes up again. So we're right around 27. And if we map this out to the comparison to S&P, it should be opposite. Okay, as the stock market goes up, the VIX goes down. As the stock market goes down, the VIX goes up. So we know people are starting to get scared. They're not super scared yet. Okay, we talked about that already. Okay, I'm going to bring this picture up. This is a good lesson learned from this is a July 2021. We were talking about this. This was over a year and a half ago. I forget who gave me this chart, but it's basically how much money, when the Fed gives money to the economy, it's quantitative. Then you have quantitative easing where you take money away. There's a direct correlation to the performance of the stock market. And we mentioned as we were reaching this peak, we knew at that time, July of last year, the Fed was starting to raise rates. And we saw, the time last time when this happened, we had quantitative easing, we had paper tantrum, we had all these different times when we started taking money out of the stock market, and the stock market corrected. We don't know how much, that's what's happening right now. We don't know how far the stock market's going to go down, in this, as the Fed takes the money away. But as a long-term investor, I wouldn't change anything because I know that I'm still invested in stocks that are growing 7 to 10% a year. And this is just going to be a blip. This is going to be one of these blips in our long-term chart of the S&P going up. So we have to keep in mind next time the Fed is reducing interest rates and putting money into the economy, we will know that the stock market goes up during that time. And no one would want to be investing then because the economy won't be doing as good and we'll be back in the starting point again for getting the economy going. So that was a really good lesson learned. Let's look at, right now we have a lot of contrary reports. This guy's at Sober Look on Twitter. He notes that the investors' appetite is down to where we were in the 2008 financial crisis, and the net exposure to equities is as low as it was in 2008. So these are all contrary indicators. When the average investor isn't investing and taking money away from the stock market, that's like a contrary indicator of when to buy. So we had a problem last week where the unions were threatening a rail strike, and that didn't happen. And the president came in and tried to get things happening, and a rail strike was averted. So that's really good for the economy because that would have been a sure recession if we wouldn't have any rail traffic. Rail traffic is 20% or 30% of the economic goods bought in America. So if that stopped, we'd definitely go into recession. So that's really good for all the rail stocks that we're following, CSX and Union Pacific, Warren Buffett's company. So we already talked about this. We don't know if this is a company-specific thing with FedEx or not, but this is an example of a canary in a coal mine. A couple of weeks ago, we were saying the economy, the next shoe to fall is the earnings reports. And if the companies continuously issue profit warnings and say things like there's no demand from the consumer, we're not going to meet our estimates, then that'll be like a tidal wave in the stock market. It'll just sell off. So we just have to. It's a really unstable time right now for the stock market because we don't know what's going to happen with these company earnings. So we have to focus on these things. Companies with stable demand, they can raise their prices, and they have a low PE ratio. Drug stocks, energy stocks, even defense stocks right now. We have every country in the world looking to ramp up their defense because of what Russia did. You got to think that there's a constant demand for defense purchases. And let me see what else. Consumer discretionary, there's always a demand for food and goods like Procter & Gamble sells. Let me see. All right, so let's keep our eyes on this little list here as we look through the top 10 performers and the ones that aren't going down as good. Chances are they can raise their prices. They have consistent demand, and even if we're in a recessionary environment, they'll still give out dividends, and we'll have a stable demand. All right, let's go back into some of our talking points here. We already talked about that. Okay, we've been talking about Stanley Druckenmiller. He's been pretty negative on the stock market for at least a year and a half since Bitcoin started going up, and since there's a lot of froth in the market. But he's performed over 30% for his fund for the past as long as he's been doing it. So that's a really good track record. He said there's a high probability that it's going to be flat for 10 years, sort of like 66 to 82. And also we had that time between 2000 and 2010. Because if you have higher interest rates for an extended period of time, like he thinks it's going to go up to 6%, that'll make the economy basically not grow. And we looked at his top 10 holdings, and they were some of the ones we're following because they're consistent demand. He said, with raging inflation, central banks raising rates, deglobalization, and the war in Ukraine, he says the odds of a global recession are now highest in decades. And we put that together with the report from FedEx predicting a global recession. So maybe, just maybe, we have to start changing the way we invest if we know it's going to be a flat market. So what do you invest in a flat market? When we go back to look at our top 10 market movers. Okay, so we have the ones doing the best, or the ones paying the highest dividend in the Dow, for instance. The ones that are drug stocks. The ones doing the worst are stocks that are tied to the economy, like Boeing. As people spend money on trips, the airlines buy more planes. But if there's lack of demand, these are all stocks that are pretty much they go up and down as the economy does well and not well. Let me see, and I would expect more. This is the oil stocks are going down today. Okay, so let's keep that in mind. All right, so maybe we should start thinking about trading around positions. Jim Cramer, I follow what he does all the time because I listen to his show, and he says what he does for his charitable trust. He likes to trade around positions. So what he does in his portfolio. Okay, let's look at an example stock. Example stock. Let's say a trading stock for him. Bristol Myers. He likes to buy stock, at a low and then sell a portion when it's high. And he would map out the stock, and where it's trading, and a lot of times you have stocks that are in tradable ranges like this one right here. This is Colgate. He would buy it here, sell some when it gets up here, and buy it back when it gets down here, and sell it when it gets up there. That's an example of trading around a position. And if the stock market is going sideways for 10 years, that's a good, for maybe 5% or 10% of your portfolio, that's one way of making some money. Or you can buy stocks that are giving a yield. So at least if it's flat for a year or 10 years, you'll have some kind of return on your money. So, but for me, I'm still convinced that Google's going to grow at 13% a year for the next 10 years. If it goes down, that's that's like a temporary thing in my mind. All right, let's look at another. I already talked about this. This is
So,
yes.
Greg, I guess the other, instead of trading around position, some people they sell covered calls, right?
Oh, yeah.
So they lose some upside, but if you don't think it's going to go up, you can sell covered calls.
That's a great point. Let's go back. Someone asked me this week about calls in general and puts. Let's look at S&P. Okay, selling calls and like covered calls. It's an example of a conservative way to generate money. If you have a predictable range, let's say in a stock or an index. Let's say, as an example, let's say all of your money. I'm just giving an example. So a certain part of your money, let's say 10% of your money is in the S&P, and you're willing to sell a portion of that, like 1% of that, anyways. And what you could do is you could write covered calls every month. A lot of times you go out a certain amount and you say you have a predictable trading range. Let's say we have this up and down right here. We could, let's do a trade. Let's do that with my charts here. Colgate-Palmolive. Let's say I own 100 shares of Colgate-Palmolive. I'm willing to sell it right now. We're right here in the stock. But let's say we're right here. We're kind of towards the top of this range. We're willing to sell in a month at this time. We're willing to sell our stock to a trader at this price in a month. And so what you do is you sell the right. You own the stock, 100 shares. You sell the right for someone to buy that stock right here. As we follow this stock, we see it's overbought. It's overbought. We know usually in a month it'll go to a position where it's oversold. So we're guessing that right here we'll give the right to someone to sell. We'll sell the stock to someone at this price. And a lot of times that just expires worthless, but we collect maybe 1 or 2% of the total value of that stock. So that's a conservative way to make money in a sideways market. The only problem with this is if it does go up here, you lose whatever amount that it went up, number one. And number two, you have to sell that stock or cover the call. And regardless, you're in a position where if you sell the stock, you have to pay capital gains. And but if you're willing to sell it anyway, that's an example of, a way to make money in a market in addition to the dividend you're getting from this stock.
Yeah. But if you're doing that trading strategy you're talking about, you are forced to sell the gains at a short term.
Yeah.
Right? And you lose the upside because you're selling at the top end of the range.
Right. So you have to be willing. You have to be in a position where you're willing to sell. And, if you have a really big position in something, like half of your money is in Colgate-Palmolive, your financial advisor would say, you got to get rid of some of that. And, this is a way to do that. You can sell the right for someone, and you can do this for years if you follow a pattern like this where it's oversold, overbought, oversold, and you match it up to the S&P maybe. It might take you a while to sell, that half of your portfolio position, but you can make some money doing it. And actually, there are, I've followed some covered call newsletters, and a lot of times whenever it does get to the strike price and it goes over it, the good cover call writers would actually buy another call and sell this one. And in that sense, you're still kind of almost break even or losing just a little bit. But it's still a very hard thing to do if you're not watching the stock every day, because you could be really freaked out if your stock goes up to here or something, and then you have an unlimited amount of you're losing, and then what do you do? And when you have to get something done at work, so I mean, it's really you got to be willing to sell the stock basically at that price. Then you're okay. You'll make your 3%, and you're forced to sell it, and that's kind of the easiest way to do this. But if you're doing calls and options, it's a very risky thing. But if you're using this covered call strategy, and you're willing to sell the call, and if you have someone like a financial advisor watching over your trade and making sure that you're doing it the right way, it's a good way to make money if you already own stocks that you're willing to sell. And you make more money in your covered call strategy in an environment like this, where it's very volatile. Even though, we can see this Colgate-Palmolive isn't really that volatile. It's a predictable range. As the volatility goes up in the stock market, I think the Black-Scholes algorithm is, as the volatility goes up in the underlying security where you're writing the call, the premium you pay for it goes up. So I was toying with the idea of going through a covered call example again. Is anyone interested in that? No one's interested. Okay, we won't do that. But options are very risky, and especially selling a call and selling a put, because you could be forced to. It's called a margin call, where you have to liquidate some of your portfolio if you do the wrong trade. So I guess that's a little more out of scope for what we're doing here. We're buying and selling stocks, in growth stocks and high yielding stocks in this portfolio. So is there any questions anyone wanted to go over? We've got a couple minutes left. Okay. What I'm going to do is I'm going to go over a quick, just an example of what calls and puts are, because we haven't gone over that in a while. Okay, let's look at. Okay, so calls and puts. Okay, what I did was I just looked up on Yahoo Finance. We're going to do a straddle. A call is a security that allows you to buy the right to acquire a stock at a certain price in the future. And a put is a security that allows you to sell a stock at a certain price in the future. And these one call allows you to leverage 100 shares of the underlying security. And same thing with a put. So right now, the S&P is currently trading at 382. So let's look at our S&P chart. So let's look at 382, and let's look at our stochastics. Okay, 382 right now. Let's say everyone's pessimistic now, so the price of calls are really low. So if we looked out and we thought maybe in a month that the S&P would be trading at 400. So if we have the zigzag pattern, right? We think that S&P is going to go back to 400 in a month, because we know the end of September will probably start going up again. We would look at a 400 strike call. The calls are on the left-hand side, and then the puts on the right if you have a straddle mode. That's right, straddle. So we got to look at 400. You can see that there's a mark right here where there's in the money and out of the money, and that's like right here. So everything that's above the in the money is kind of at a discount. No one, look, it's down 87% today. This one, it's only trading at a penny for a call for a month. That's for a day. Let's go out a month. That's September 16th. Let's go out until 2 weeks from now. No, 1 month from now. October 14th. Okay, so we got the 400. We pay a premium of $4.08 for the right buy 100 shares. So you, instead of paying 400 times 382, if you bought the stock outright, I think it's 482 now. 382. 382 times, that's, okay, it would cost you $3,800, like $38,000 to buy 100 shares of S&P right now. Or you could pay $4,080 for the right to buy it in a month at $400 a share. So, but if it doesn't reach, if the stock does not reach that 400 in a month, and let's say it trades down to here, you lose all that $4,000. So that's basically, and every day that goes by where the stock is, every day the stock exists, the value of that option goes down because it degrades over time. So, so you have a time premium that you pay for options that you don't pay for in stocks, because you can buy and hold stocks forever and not be charged. But I think that that's an example of a call. I guess we can go over an example of that next week. We just did right now, but we'll keep track of that. We would have paid $4,000 for that. Next week, the value of that same call is probably going to be $3,500. And if we go into a market where it's crashing and the stock market's down here, the value of that call will be like $0 or $100 a share. So, all right, next week I think one thing we can go over is what to do when the stock market crashes. You know, we're in a spot right now where the stock market is in a precarious position. Money's being taken away by the Fed. The Fed's raising rates, and we saw from our chart from before, you know, something like this could happen, and it happens every time we end our quantitative easing. The government's giving money, and what do you do whenever you have a crash? For me, it's I hold everything and know there's better times another day. But if you're not invested, you know, how do you buy, or how do you accumulate a portfolio in a crazy time like that? So we'll go over that next week, because you know we're getting a crazy part of the year, the crazy time of the year where it's October, September, bad time, bad month. Until then, if you have any questions, let me know, and we'll go over them. And I hope you have a good weekend.